One of the biggest deals in the energy sector this year is the merger of two major pipeline companies in the U.S. The deal involves ONEOK buying Magellan Midstream Partners for $14 billion, including $8.8 billion in equity and $5.1 billion in cash. But what does this deal mean for the pipeline industry and the energy market? ONEOK is a diversified energy company that operates natural gas pipelines, processing plants, storage facilities, and fractionators across the U.S. It also owns a stake in Northern Border Pipeline, which transports natural gas from Canada to the Midwest. ONEOK's main focus is on transporting and processing natural gas liquids, NGLs, which are byproducts of natural gas production such as ethane, propane, and butane. Magellan Midstream Partners is a master limited partnership that owns and operates refined petroleum products pipelines, terminals, and storage facilities across the U.S. It also owns crude oil pipelines and marine terminals in Texas and Louisiana. Magellan's main focus is on transporting and storing gasoline, diesel, jet fuel, and other refined products. By acquiring Magellan, ONEOK will expand its footprint in the refined products market and diversify its revenue streams. The combined company will have more than 40,000 miles of pipelines, 120 terminals, and 80 million barrels of storage capacity. It will also have access to key markets such as Houston, Cushing, Denver, and Chicago. The deal will create a mega pipeline company that will benefit from economies of scale, operational synergies, and enhanced growth opportunities. The deal is expected to generate annual cost savings of $100 million by 2024 and increase ONEOK's earnings per share by 10% in 2023. The deal will also strengthen ONEOK's balance sheet and credit profile, as it will reduce its debt-to-EBITDA ratio from 4.7x to 4.2x. The deal is subject to approval by Magellan's unit holders and regulators, and is expected to close in mid-2022. The deal will be structured as a tax-free exchange of units for ONEOK's common stock. Magellan's unit holders will receive 0.4148 shares of ONEOK for each unit they own, implying a premium of 18% based on the closing prices on November 15, 2021. The deal is a sign of consolidation in the pipeline industry, which has been facing challenges such as low oil and gas prices, regulatory uncertainty, and environmental opposition. By joining forces, ONEOK and Magellan hope to create a more resilient and competitive company that can deliver value to their shareholders, customers, and communities. The deal will create a mega pipeline company with more than 40,000 miles of natural gas and natural gas liquids pipelines across the U.S. This is a significant expansion of the existing U.S. natural gas pipeline network, which has about 3 million miles of mainline and other pipelines that link natural gas production areas and storage facilities with consumers. Natural gas and natural gas liquids are essential for various consumer and commercial needs, such as heating, cooking, electricity generation, and industrial processes. The U.S. produces most of the natural gas it consumes, but also imports some from Canada and Mexico in pipelines, and a small amount as liquefied natural gas. The new mega pipeline company will have access to some of the largest and fastest growing natural gas markets in the country, especially in the Northeast, where demand for natural gas has increased due to lower prices and environmental benefits. The company will also be able to transport natural gas liquids, such as ethane, propane, and butane, which are valuable feedstocks for the petrochemical industry. The deal is expected to create synergies and efficiencies for both the pipeline operators and the customers, as well as generate more revenue and profits for the shareholders. However, the deal also faces some challenges and uncertainties, such as regulatory approvals, environmental impacts, safety concerns, and competition from other energy sources. One of the benefits of the $14 billion deal between ONEOK and Magellan is that ONEOK will gain access to Magellan's refined products pipelines and marine terminals. These are valuable assets that transport and store gasoline, diesel, jet fuel, and other petroleum products. Refined products pipelines are pipelines that carry refined petroleum products from refineries to distribution terminals, where they are loaded onto trucks or railcars for delivery to customers. Marine terminals are facilities that receive and store refined products from ships or barges, and transfer them to pipelines or other modes of transportation. Magellan has a network of refined products pipelines that spans 9,800 miles across 15 states, and connects to 53 terminals with 42 million barrels of storage capacity. Magellan also owns 5 marine terminals located along the Gulf Coast and the East Coast, with a combined storage capacity of 26 million barrels. These marine terminals serve major markets like Houston and New York, where demand for refined products is high. By acquiring Magellan's refined products pipelines and marine terminals, ONEOK will be able to diversify its revenue streams and expand its customer base. ONEOK will also be able to leverage its existing natural gas liquids, NGLs, pipelines and processing plants to supply more feedstock to refineries that use Magellan's pipelines. This will create a more integrated and efficient energy infrastructure system in the U.S.